We are back again with Andrew Pink here on Morning Markets. He's with LDIC. He told us in our first conversation his portfolios tend to be defensive, and he's got some ideas on where to invest in a declining rate environment. Let's talk about the REITs, because you believe, depending on the sector, the real estate sector, that REITs can be a wise investment.
Yeah, there's a bit of a caveat here, and that is we don't want to be invested in REITs that are too economically sensitive. So we pick, in this environment where there's some uncertainty out there, we pick segments of the REIT market that would be more defensive, less economically sensitive, such as healthcare REITs. They don't fall under specifically the REIT GICS sector, but they fall under healthcare now. They've recently been changed, but we still deem them to be real estate companies. So something like a Chartwell or Sienna does very well in an environment like this. These are senior residences, very durable investments. There's a lot to like about these companies. Some of the industrial space we like internationally. I know that there's a bit of a mixed bag within that segment, but we do like that space. And then on the retail side, grocery-anchored retail is a very good place to be invested right now. We don't see any turbulence within that space. We think there's a good runway. There's lots of visibility in this space. So those would be the three kind of pockets that we invest in currently.
Do you expect capital appreciation as well as that flow of distributions from the REITs you like?
We definitely do, and that comes from this interest rate dynamic that we're talking about. So as the Bank of Canada cuts interest rates, the yield on these investments, even the equity investments, become more attractive because you can't get a higher risk-free rate. So investment flows into the next level of risk, and these healthy dividend yields of 5 or 6% become even more attractive. So you see money start to flow in there. That gives you your capital appreciation.
What sectors of the real estate market would you avoid in real estate investment trusts?
Yeah, we're still avoiding office as an example. We're looking a little more closely at the multi-residence. There might be a place to invest there. Not quite yet for us, but we're avoiding those kind of spaces.
When will the office space become more attractive?
That's good. We're going to have to get through some inventory, and we're going to have to get less of the hybrid working environment happening. Right. And we're going to have to churn through that inventory to get rents back up and get workers back into the office.
Right. That was one of my questions. I mean, we are now 5 years plus from the pandemic. It's pretty clear that work from home is not going to completely disappear, is it?
No. This is a structural change. We were deciding whether this was structural or not, and maybe about 2 years in, we thought we had a very good investment in one of the office REITs at a 40% discount to NAV, and it just still didn't work out. So we've said that space for now is not investable for us. So we're going to wait it out and watch to see where those discounts get to. Okay.
Another sector you like is midstream energy and the utilities as well. So midstream energy, that's the pipelines, is it?
Correct. Pipelines and gathering systems and storage and that kind of thing. So while we're not invested in the oil producers at the moment, we've sold those as of the end of last year just to stay away because they're sort of a first derivative on tariffs type investment. But on the midstream side, we think energy is still going to flow, and we still like that space. These are highly contracted revenues and companies that pay good, healthy dividends. And so we like that type of, I'll call it like a bond type structure where you've got a very good, stable, free cash flow investment in a declining interest rate environment means that, again, those investments are going to become more valuable.
Okay, we're almost out of time, but I know you like a particular type of preferred shares as well, prefs.
Sure. We've come out of what we call the rate reset prefs, which are kind of floating rate. There's a mechanism there that creates a floating type dynamic there. And we've moved into fixed rate preferred share investments. And these preferred shares, you remember that in an individual company in the capital structure, you've got fixed income at the top, preferred shares, and then common equity down below. So these sit in the middle there. They pay about a 6 or 7% dividend yield. You're tax advantaged because of the Canadian dividend tax credit. So that grosses you up to about 7 or 8% after-tax yield, which is quite compelling. And it's fixed rate, so just like bonds, interest rates go down, the prices go up.
Andrew, thanks a great deal for a couple of good conversations.
Thank you for having me.
Andrew Pink is a portfolio manager at LDIC. Those are his thoughts on where to invest right now. When we come back,